This is the Tesoro AI podcast with Darius Gant. AI is changing the world and fast. This episode is coming to you courtesy of Tesoro AI, the #1 recruiting service for software development and AI talent.
All right, Adrian, welcome to the show. Appreciate you taking some time out to join us.
Hey, excited to be on, Darius.
Absolutely. So before we talk about what you've built with Mendoza Ventures, we'd love just to learn more about your background. I know you're very focused on design. You've been a founder in the past yourself, but tell us more about Adrian and then even your professional career leading up to what is now Mendoza Ventures.
Yeah, I've always been at the intersection of technology and design. And really that started in like building web page in the early 90s, like very early, just learning about it. Ended up paying my last year of college doing it
Oh,
because
nice.
I realized, yeah, it was like amazing because, I was on financial aid and, paperwork ended up getting, and so I had this massive gap, and it happened to be I was doing some work on our own just at the very beginning, like this is 1995, 1996. And someone went up to me and was like, "Hey, you know how to do this? One of the departments needs their own web pages." Next thing you know, we're cranking these out, we're making them for different people. And it covered myself and it covered another friend who did it with me, and ended up getting my first job out of college was at Disney, at Walt Disney Imagineering, and kind of continued that sort of design
Right.
intersection of technology. We were doing some very cool stuff there. And I was probably 98, got this amazing opportunity to come out to the East Coast, sight unseen, and I came. And I happened to come right in the middle of the dot-com boom.
Okay,
The thing
right.
to read about, like I was right there in the center of it. I was seeing companies being built, companies being sold, companies going under, like in the span of months. Like
Mm-hmm.
you're looking at like an entire ecosystem life cycle happening in like months, not years.
Right.
And it was kind of crazy, but at the same time, the West Coast, there was this vibrant tech ecosystem in Boston, became part of it. Wasn't a lot going on the sort of Southern California, so stayed. Built an interesting small design agency here, did really well, and then sort of late 2008 got recruited to go into a startup, and away we went. And the next thing you know, built my own startups. This is 2008, 9 to 2010. I had been doing a lot of work for some of the brands on e-commerce because I had this, like, at that point, like over 10-year background of working at
Mm-hmm.
brand at IBM. And we saw this interesting intersection between the performance of mobile websites and apps and how they were connected into revenue. Roll the clock forward, mid 2015, the board said, "Hey, we want to sell this company, go find something to do." And I did.
Okay. So
And
was that startup venture backed?
it was
Okay.
venture backed. And so we had pitched everybody. We knew like who the investors are. We knew who the service providers are. We knew who the engineering teams were. We had teams in like India, Croatia. We were writing lines of code 24/7. And it kind of taught me a lot about sort of building out a technology team, building out a design team, building
Right.
out like all sorts of this, because so much of a company, because to take a step back, because I had the most technology experience, I became what I call the unofficial CTO, or the accidental CTO. But I had this idea of having worked with the business through my own agency, having worked with brands, that I could connect what the sales and the business team was doing to the technology and the design
Okay.
team. And that was always this core strength. And towards the end of that life cycle of that venture backed business, people would ask me, like, "What do you do?" And I was like, "My job is to unblock people. Like, I don't write lines of code. I don't design anything. I just unblock teams so that they can get the work done."
Mm-hmm.
And that kind of was really core to when we built Mendoza Ventures. This is 2016. There was no such thing as ex-founders that were writing checks other than angel checks. There was no ex-founders that had funds. Like we were one of the very first, and it was still really new. But at that point, like we had seen other founders. We knew we were founders ourselves. We
Right.
really had this very founder focused view of how do we build businesses. And at the same time, like we had bootstrapped our businesses before, doing fintechs for the bank. So, and kind of away we went. And it was myself and my partner, Jennifer, and we kind of were like, we want to do this. And we tried it out. We did really well for the first couple of years, Mendoza Ventures. And in 2018, we raised a second fund. In 2023, we raised a third fund, and off we went.
Nice. Yeah, and congratulations on, especially in 2023 is a rough time to actually be raising a fund, including this year, right? I think a lot of folks think about uh, the challenge for startups raising capital, but there was also a challenge for the funders on the funder side actually raising for those that needed to raise a new fund in those years. It's also challenging. But I do want to come back to this transition from founder to then investor. I guess you've got founders, and as you mentioned, traditionally back in 2016, you had few founders who then became funders, right? Or fewer, I should say. Now it's a lot more common. What was it for you about venture capital specifically that made you say, you know what, I'd rather take this path than to go out and do something like start another, or well, I guess I should say, take a few years vacation and then start another startup.
I think I took 30 days off, and then my wife was like, "Get the hell out of the house." And then it was like, "Oh, what are we doing next?" You know
Right.
what? Part of it was when you go back to having raised VC money ourselves, having been in those rooms and pitched, you were pitching people that had never been founders before, had never built a business. They
Mhm.
were lawyers, asset allocators. They had investment banking backgrounds. And look, I had spent some time at B school. Like I knew the type, but I was like, oh, you guys aren't entrepreneurs.
Right.
And so it was really revolutionary to be like, oh, we've built businesses. We can help. We can help you with a customer. We can help you. Like I had brought in 2008 the first mobile app to FINRA approval, and literally the iPhone was only like 12 to 18 months old. But part of it was when we took back and we went through our experience of having raised money, you were raising money from people that had no technology backgrounds, that had not let alone being entrepreneurs, but had no domain expertise. And at the same time, the big piece is that venture is a blind box.
Hmm.
Those that invest in funds never get to see where the investments go, and us as recipients never get to see who's in these funds. And so we had experiences with people years afterwards where say, "Oh, I know you." And I'm like, "Who are you?" And they're like, "Oh, I came in through this fund and I came in through that fund." But I was like, "Wow, if I had access to you." And so at the beginning of Mendoza Ventures, we didn't bring outside capital. It was just ours. And we said,
Okay.
well, we're not going to risk it. We're not going to risk because this is a harebrained idea at that point. Like
Right.
two ex-founders thinking that they're going to start investing, and like this was like no, everybody was like, you people are crazy.
Hmm.
And we did 3 investments, but at the same time, like, that first year, we were seeing everything from, like, doggy dating apps to blockchain companies to, like, everything under the sun, and 3 months into it, we're like, "We need to stop. We need to, like, focus on what is it that is core to our strength? What is it that we bring to the table that we can do
Yeah.
diligently really quickly within our network?" Because I had this incredible network of individuals I worked with. I had a guy that the VCs used to tell me, like, "How'd you bring this guy in to help you?" And I was like, "I installed molding in his house." He was like, "What? How'd you get this senior IBM guy to help you?" "Well, I bought him out for pizza and then bought him like barbecue." And so we had this incredible network of people in the tech economy that as we were sort of going through this thing, we're like, well, we know these people, we know these spaces. Why don't we start investing in spaces that we know?
Right.
And that in Silicon Valley was like like, what do you mean you're going to invest in spaces that you know? Usually we invest and then we hire someone to get us smarter on it. And I was like, no, we're going to go the inverse. We know these spaces. Let's just focus thematically. And that was very different at that time because there weren't no thematic funds. And
Yeah.
we netted out on like, we're going to focus on, we're going to do one AI, one FinTech, one cybersecurity company. And then we're going to learn about how we want to do diligence as founders, how we're going to dig into the tech, how long it's going to take us. And, we did three investments. The first one, we had a quick exit in 5 months of investing,
Mhm.
returned 10x back to us for a cybersecurity company and was like, oh, we're on the money. The second one, the first investment we ever made, that one, was just like a rocket ship that took off really quickly. And then the third one, both of the first businesses have already sold. The third business is still there and doing pretty well. And we were like, oh, okay, I think we've done really well in choosing. Then we were approached by individuals that were outside, that were other investors that said, hey, I have been following what you're doing. I like what you're doing. And that's when we brought outside money in
Yeah.
because we did it like founders. We did a POC, we did a proof of concept, we ran the proof of concept, we learned, we iterated, and then when we figured out, we were like, this is the product that we're going to build.
Yeah. And that approach, that focus is interesting to me because it reminds me a lot of kind of the old Warren Buffett, Berkshire Hathaway approach, where it's, hey, focus on the sector, understand the sector really well, understand the assets within the sector really well, and then make an investment, right? Versus having kind of like, if you just think about venture broadly, hey, we invest in everything. Well, there's no way you can know everything. Or if you try, there's someone who has more knowledge about the sector that is better able to pick the winners within that particular space, right? And so I think from a private equity, growth equity, venture capital side, it became even more important to have this sector expertise as different investors started to add on, like you think about Vista Equity Partners adding on their consulting arm. And
Right.
now we both understand the sector, but now we have this operational playbook that we can come in and add some expertise to our portfolio companies as a way to accelerate their growth.
Interesting areas is when we were looking at the landscape, we ended up meeting individuals in private equity and we're looking at what they're doing. We're looking at how involved they are. They're looking at, the small amount of companies that they're investing in, how hands-on they are. And then we looked at venture and it was the Wild West.
Yes.
What I ended up doing was not rocket science. I looked at the best parts of private equity and I said, I'm going to take these traits and I'm going to move them into venture capital. The thematic focus, concentration of companies, smaller amount of investments, higher amount of investments, very hands-on, really engaged with the portcos. And that was inherently the model of when we built Mendoza Ventures. The thing that was unique to us that I didn't realize how much of a core differentiator it was is when we brought outside money in, I said the goal and strength of what we build is that we're talking to the founders, we're engaged with them, we're
Mhm.
dipping into our network. Why not get our network to become investors? Why not get them to be part of the process as well? So we build events every quarter where we're putting the founders and the funders together. We do an annual meeting that's in person, and last one we had this year was about 80 people. And I've talked to other VC funds and I asked them like, hey, what's your annual meeting look like? And we do an hour call and then we try to get everybody off. And I'm like, what about yours? And I said, we started at 9 in the morning. We ended at 3 in the afternoon. And if I had another 2 or 3 hours of content, people would have stayed. And we go and we focus on content. Like here's a panel on using both our portcos as thought leaders, but also our LPs to
Mhm.
talk about the thematic sectors against each of what's happening in this industry. Not like, let's talk about fintech. It's like, let's talk about fintech post neobank collapse. Let's talk about the difficulties of selling within enterprise for cybersecurity. What's that look like in the market? And it's really going focus on deep parts of the space. And in the beginning, the LPs and the founders were like, "Man, I don't know about this." By the end of the day, people were raising money in the background. Other LPs were like, "I love this founder. Can I give her $100,000?" I'm like, "You do whatever you got to do." And at the same time, these founders were meeting these LPs that are domain experts and saying, "I want to build a advisory board. Can I pull from your base?" I'm like, "That's why I'm doing this together." And through this network, we've built relationships for people to co-invest, people to invest, people to become board members. And that's, I think, that a very experiential thing that we learn from being tech founders that we brought in. Because one of the interesting things that I've seen post COVID is pre COVID, when we were founders, there was an event every night. You were
Mhm.
meeting with investors, you were meeting with other founders. I think a lot of that has been lost, but we were like, let's recreate this very engaged model where we're just putting both groups together and curating the experience, because you've got these incredible men and women with 20, 30 years of domain expertise that can unlock doors. And you put them in the same room with these founders that are building the companies, and just magic happens.
If you're a hiring manager and you appreciate the unique skill sets required to build AI solutions, then I would highly suggest you get your hands on our AI talent salary guide. As you know, one of the greatest challenges in building AI products is acquiring the right team. Over 100 plus pages, we dive deep into our global AI talent acquisition strategies. And with our networks in Latin America, we also provide you with actionable advice on how you can scale up your AI team cost efficiently. Once you explore our AI talent acquisition strategies, you'll never look at hiring the same way again. Links are in the description.
Right. And so you mentioned cybersecurity, AI, and FinTech as the core themes where you invest. Did you also, and I believe there was kind of a focus on Latinx or underrepresented founders, was that also part of the investment thesis?
The funny thing is that it's never been part of the investment thesis at all. It happens to be Mendoza Ventures is Latino and women owned. And guess what? We're investing in the best talent, regardless of where they live and what they look like. At the
Mhm.
same time, you've got talent that are, a female CEO in her 70s, or, in her 70s, a CEO that's a veteran, that's next naval intelligence, CEOs that are Black and brown female immigrants. And we're literally taking what our firm looks like and
Mhm.
deploying the dollars into what we see. Because when we were founders, we never saw Latinos writing checks, we never saw women writing checks. And so we filled in a gap of what we saw in the market.
Yeah, awesome. And curious what your experience was. I mean, you're now on Fund Three, just raised Fund Three in 2023. You mentioned first fund, self-funded effectively by you and the co-founder. As you had to go out and raise outside capital for Fund Two, what was that experience like? Did you find that there were certain investors who are more fit to be LPs than others? And then did that change as you raised Fund Three?
Yeah, it was interesting because we always get approached by other fund managers or other founders that want to raise a fund or start investing.
Hmm.
And they come to me and they're like, "How did you do it?" And I was like,
Yeah.
"Okay, here's my advice," and I'll share it right here. I said, "There's three circles. Your first circle are people that know you and love you. They're like, Darius is going to raise a fund. I love Darius. And you don't even have to have a deck." And they were like, "Sounds good. I believe in who you are and what you're doing, and I want to do something with you." And they're the easiest one. They're the visionaries. They're the converted. They're those that just know you personally. And for us, when we raised Fund Two, we started raising, and the biggest investor was someone we knew who said, it was a guy that went to the school of one of my kids, who
Mm.
had his own family office, and said, "I really like what you guys are doing." And he's like, "I already have a decision. I just want to hear the pitch." He never even saw the pitch deck. He believed in us.
Yeah.
And that's what was incredible, because that kicked it off. You had someone that was like, "I believe in you guys. I love what you're trying to build. I love what you've done before. Let's do something. So that's kind of the first circle. And that's the one that I think you always want to sort of pull in first, because they're going to be the ones that, because doing this for the first time, it's a lot of work. There's a lot of
Mhm.
things you're going to learn. It's going to be ups and downs. And that group is going to be your ride or die.
Right.
And then there's the second group. There's the people that you know, maybe you worked with one or two jobs ago, maybe you have a relationship. They're going to want to see a pitch deck. They're going to want to see you put pen on paper. What are you thinking about? What does it look like? And they're the ones that you may have to do a little bit of education, but they may have known you, heard about you, and they're going to come and say, well, so and so invested. And I don't know Darius. I know I've heard of him, but
Mhm.
I'm going to, sure, I'll take a chance. And that's a little bit harder because they still want things, materials. And then you get circle three, and those are people you've never met ever in
Right.
your life. And they're going to be the longest to close. They're going to be the longest ones to convince because they have no idea who Adrian or Darius are. They're like, oh, there's 10 other funds. We get approached by 10 other funds. They may be sophisticated investors, they may be angel investors, they may be LPs before. And so that's one of the things that as we started pitching those group, and it takes about 2 years to raise a fund, we realized that there was this incredible gap going back to, my entrepreneur finding a gap in the market and filling it. And
Mhm.
it was individuals that were women, people of color, that were first time LPs. And I would say a majority of our fund too are first time
Mm.
LPs that had never been given access and now are coming in and saying, wow, I can get access to venture, to someone that looks like me and someone that's engaging with me, but also I'm willing to learn from and we're willing to educate them. And interesting enough, I would say about 30% of our LP base was first time LPs. Once you open the door, they're now in LPs in other funds that look like us, that are women led, black and brown led. And
Yeah.
so when we launched Fund 3 was now, go back to Fund 2. Fund 2 was individuals and small family offices. And at the tail end, that's when the corporates came in. Like Carta is an investor in us. They came in at the very end. They publicly wrote about us. They put it on their website. You can find it. Small endowments, small foundations. And in Fund 3, we actually said there is another missing gap in the market, and that is an institutional grade vehicle that's run by a woman and a person of color.
Before you hop over to that side, I did want to make a distinction. Like Fund 2 looked the way it looked, also partly because you have to take into consideration, right, fund size, and then if it's this larger corporation or larger like a CalPERS or something, it's like, hey, there's a check size that we also need to write. There's an amount that we need to deploy per fund we invest in. And so sometimes also you've got those smaller family offices and individual investors in, like a first fund where that's like the sweet, like that check is perfect, right?
Well, and part of Darius, I think you're touching on a really good point that I think a lot of people like. This is a sales cycle. This is going out as a founder and selling, and you have to match the right product to the right person. So, and I learned this very early on, and now I'm like, what was I doing? Like, I would go out to the big CalPERS and I would go out to the big thing. These guys were on to write a 60 to $200 million check. They're not going to come into a $15 million fund. And I
Right.
tell that a lot to people to be like, and even now, like, you I stopped going to a lot of these bigger institutional investors because they want to write $200 million. They're not going to write into $100 million fund. And so
Right.
you have to, qualify your leads. You have to figure out that you have product market fit so that you're not trying to present a tiny fund run by founders to a big, CalPERS or Texas retirement, because they're just never going to do it. And that's kind of the thing is, usually your first LP base are individuals in small family offices. And maybe when you've de-risked it, endowment or a foundation, but even to write bigger checks. And how we were introduced to them is it was just through our network. But
Mhm.
part of it is as you scale, then you're able to get to the much larger investors. So for Fund 3, it was, the first, 2023 was focused on closing three banks: Bank
Mhm.
of America, Truist, and Grasshopper Bank. And they are very public about being investors in us, and they're very incredible partners. And they did it because they said, hey, this is a strategic investment for us. We want to meet your companies. We
Mm.
want to meet these Black and brown and female and fintechs and insurtechs and cybersecurity companies, because this is what the bank is looking for. We
Right.
want to bring them in because, at a certain point when you scale, you want to be able to bring a proof of concept with one of these financial institutions. Also, it was much larger family offices. And so we're kind of moving through. But one of the things that we did, I said, what made us magical was giving access to individuals. So I went back to Bank of America and said, hey, you guys are really, you don't really want individuals in your institutional fund. And they said, yeah, it's viewed as risky for us because someone might default, someone might get divorced, someone. I said, here's what I'm going to do. I'm going to make a small little parallel fund that has all the same economics, the same
Mhm.
features, and it's just going to be for accredited investors. Do you mind? And they're like, no, go ahead. And we raised about $5 million in 90 days. And it
Mm.
was an awesome, amazing group of investors that were like, I heard what you did. I want to be part of this community. I want to help. I want to invest. And it was going back to that base of first time, LPs, first time investors. And I didn't realize how critical that was in the market, because I go back to my experience. I was an accredited investor for 10 years and didn't know it.
Mm.
But like, where was I going to get access to a venture fund? Nobody.
Right.
Now everybody is like, hey, Adrian, will you come into our fund? Before that, no one was asking me. So, you know, I nowadays, when people ask me what I do, my response is I build products that people want to buy. And these are financial products.
Mm.
And if you're successful, people want to buy them because that's what a fund is. It's just a financial product. And so we said, let's build a product for banks, let's build a product for individuals. And that's really like when you take a step back and leveraging like our view in the market is where are there gaps, where are there opportunities, not just
Right.
in investment, but for others to invest in financial products and funds and vehicles or SPVs that are going to make sure that they're getting access to companies and founders because it's a right fit for them. But it always comes back to finding the right fit. And even though, like, our newest fund is we did a first close in 2023, we still have a little bit more we're going to raise. But
Hmm.
the reality is it's finding great partners that want to
Right.
come along for the ride, that see it as a strategic investment, but also because they see these sectors and they see these founders that we've exited before, that we funded before, and we're like, yeah, I want to invest in more like that.
Yeah. Yeah. And so Fund 3, I guess, what's the target for Fund 3?
It's $100 million fund, anchored by the largest bank in the country, which we're pretty excited and proud of. They've been a great partner. But at the same time, Bank of America just invested 500 million into the biggest group of diverse led fund managers ever.
Yeah. And right now my questions are more so I imagine helping the folks who are aspiring fund managers. As you thought about that 15 million, I think you mentioned the second fund was 15
Yeah.
million, and then this new $100 million target for Fund 3. How do you determine like what fund size? Because I've seen folks go out first fund, we want it to be 100 million, right? With no experience. As someone who's going out, okay, I need to go raise a fund, and maybe whether it's my first fund or second fund, how do you what do you go through? What's your process for determining what would be the right fund size?
Yeah, well, I think there's two pieces of advice. The first one is you've got to look at the base of that first circle. Who's around me that I can quickly raise? Because you don't want to spend 2, 3 years trying to raise a fund and then you never get to build a track record.
Right.
And the first thing is look at this base around you. Look at that first circle one and first circle two and be like, what can you get? And that starts defining out like what fund size. Because the biggest experience that you want to get are two things of experience. The first experience is you want to be able to have a track record. You
Hmm.
want to show that you're making investments, that you have gains, that you have exits. And the second one is you need to have experience managing other people's money. And so when I talk to someone that is a first time, I'm like, you don't have to build a fund. You can build an SPV with a handful of people, go out, invest it, but gain the experience of what it's like managing outside people's money. Because it's a lot of work. One of the biggest surprises for me was how much of a back office, because we're an exempt reporting advisor. We're registered with the SEC, with FINRA. Like we have all the registrations. We do quarterly, annual, we do audits. Like there is a
Hmm.
heavy lift. And for a lot of fund managers, I'm like, no, the job of venture isn't just writing the check. That's the easy part. That's the fun
Right.
part. It's the back office of managing this financial product. It's the investor relations. It's the, maintaining the portfolio companies to make sure that they're doing well and that when do they need to raise the next round and are there customers they need. That latter piece, that's where the majority of the work is, but that's where someone needs experience from. And you can get that from building an SPV and then taking that, a little $5 million, do a handful of investments, get the experience, and then go out to market with something larger.
Hmm.
And that's the hard thing. But at the end of the day, you not only have to look at what you can raise, the more important thing is what do you want to deploy into? And so when we were building our fund, we brought in an advisory board because this was new to us. It was before it was just us, handful of LPs that were helping. And someone was like, I think you should bring a formal advisory board of some incredible people that you can just ask questions. And one of them was a CIO who recently left our advisory board, was just looked awesome.
Hmm.
We were in New York, we'd meet every month, and he would ask me these tough questions like, all right, top down and bottom up. What's your size? How many investments? How
Hmm.
big they're going to be? The number, the size, the when, the follow on. Figure out what you need of invest and how much is investable capital. And so I would build models for him and he would review them and he would challenge me. And then after we got to a good spot, he's like, all right, I'm going to ask you the next question. What if you underraise? Well, how does the model change? What if you overraise? How does the model change? And after we went through that exercise, he came back and said, all right, now I'm going to ask you the hard question. What would break you? What would break your model? You're like, you said you're very high touch. You do that, like model that out and
Hmm.
get to a size that you could run, but that won't break you. And we built a model based on like 350 million. At 350 million, we could do a bank of 24 companies. We'd have to hire double staff. We'd have to hire risk and all of these pieces. Anything more than that, it would just break our model because then we wouldn't be able to be high touch. And that was a really great exercise to really focus on just like a very thoughtful idea of like how many companies and how do you find them, like because this is where I think a lot of fund managers they have an idea, the number, but then one of the things that happened with us in fund two, it's like, great, I've got the number of companies. There's some that I want to write a bigger check to. There's some
Hmm.
that are just taking off. People ask me like, "Hey, Adrian, like where have you getting hit in the nose?" And it was because I didn't put enough capital up front because when something's taking off and you try to put more capital in later, the valuation is much higher. And at
Yeah,
that
you
point,
can't. I bet is what you're explaining. You can't reach your pro rata, right? Like if you have pro
yeah,
rata
you
rights, you
just
can't
because
do.
at this point, your pro rata will be more expensive than your initial investment.
Hmm.
And
Hmm.
I was like, okay, that's new for us. I mean, that happened in Fund One. We had a company where we did our first pro rata. And then by our second one, it was three times more than the initial investment. And I was like, yeah, at that point, like, but the return on it was incredible. And now I look back at it as like, and we were trying to stick to our model. No, every company only gets this. Sometimes you have to like create a
Yeah.
flexibility in the model. And now what we do is we try to move more capital up early when the company is a little bit de-risked, but and then save a little bit for one more round, but then say, all right, well, we're gonna take the dilution, but we have more equity of the company.
Oh, by the way, it just occurred to me that may be pro rata may be terminology that some folks listening in aren't familiar with. Can you explain what that means
Yeah.
in layman's
So
terms?
investor, you have a percentage of ownership. And in your rights, usually it usually happens, and it's funny because there's been some confusion of when it kicks in and when it doesn't kick in. And really it kicks in when you have ownership. So when you do a price round, you have ownership in the company. You have the right to buy in. If I own 10% of the company, in order to maintain my position, I'm inherently going to have to buy 10% of the new round, or a little less based on like everyone's ownership. And then it goes out to like what the new investors want. And so if you don't participate, you're going to get diluted. Your ownership is you're going to lose, 1, 2, 3%, or whatever it is. You may lose 20 or 30%. And so normally when you hear about these startups, oh, Uber and Lyft, and look, it was this much. It's like, guys, that deal was 17 years long. And every other 2 years, these funds had to maintain their pro rata. If
Mhm.
not, they would get diluted. And I think it's funny because a lot of people forget about this, especially funds. They go and they do their investments and they're like, I'm done. And then all of a sudden, another funding round comes in, bam, they lose 20%, 30%. And they're like, oh my God, what happened? And sometimes there may be a lift, sometimes there may not be a lift, but you have to have enough capital in reserve to be able to come in and invest. If you did 100,000, should keep anywhere from 25 to 50,000 just in case.
Yeah, no, excellent explanation. I do want to change gears a little bit just so we have time to talk about the strategy for Mendoza Ventures, and kind of where are you all in terms of state, pre-seed, seed, series A, B, C? Where do you focus your time in terms of investments, and what are the guardrails in terms of the check sizes that you all write in any individual investment?
Yeah, our first two funds were really early, pre-seed to seed funds. Like we were coming in right when someone had 100K. And our first set of guardrails were, all right, we're going to come in. We're not going to come in at the idea phase, two guys and a dog. We're going to come in at someone that has a product, has a customer, and has a little bit of revenue. Because we are really, I mean, having been founders, we're revenue focused. Is someone buying it? Is someone writing you a check? And then you can talk to them and say, why did you buy it? Would you pay more? Would you pay less, like against the competitors? And so that was really like what we did in the first two funds. And we were really hands-on, but we were buying 5, 10% of the company. And we were putting a lot of work in. We may had a board seat, we didn't have a board seat. And as we scaled, it goes back to that idea of how do you de-risk the investment? Well, one, I think it's twofold. One, you wait till the investment has critical mass, at
Mhm.
about $1 million in revenue. At that point, you didn't trip over revenue. It's not an outlier. You didn't just get your buddy to buy it with you. You actually went through a sales cycle. You now have customers. You can now predict that they'll go from 1 to 2 to 3 to 5 to 10 million in revenue. So we said, let's do this. If we want to know that we want to put more capital to work, you can't do it in $1 million round. You can do it when now the funding rounds are 2, 4, 6, 10 million.
Mhm.
So for our third fund, we said what we're going to do is we're just going to wait one round later. Instead of the pre-seed to the seed, now we're coming into a late seed series A, and companies now that instead of having 100K in revenue, we want to make sure they have about 1 million in revenue. So
Mhm.
we have a space between 1 and 3 million. Also at the same time, like investors, ask me a good question. One of them said, "Hey, well, what's your perfect company at that phase?" And I said, "Sure, here's the typical profile of IC. A lot of times it's a diverse or female founder. They may have raised anywhere from 1 to 2 or 3 million, usually a lot of small checks, small funds. Typical pre-seed and seed funds are writing anywhere from 50K to 200K. At this phase, we now want to write anywhere from 2 to 5 million.
Mhm.
And I want to buy, 15 to 20% of the company. But going back to the founder, They may not have a board yet. At that point, they may not have a comp committee, an infosec committee. They may not have a CTO and financials. So we're going to be that first institutional check-in. And when in our term sheets, we usually say, hey, we're going to build out a board. We're going to find a board independent. We're going to sit on the board. We're going to bring an observer. We're also going to bring in a fractional CFO to start building these quarterly, financial packages with you. Because this is really the whole goal is, if we're going to do all this work, then let's create the infrastructure for them to help them scale.
Right.
Because I'm a big believer of what venture capital is good at is taking something that has revenue that people are buying and pouring fuel on the fire just to help them scale, get from 1 to 5 to 10 million. But in order to do that, the startup has to institutionalize themselves, just like what we did. And you've got to bring in, a right, management team that can now grow with them. You've got to bring in a fractional CFO. You're not thinking you're going to find full-time people.
Right.
You're going to buy people who surround the founder to fill in the gaps, bring in a board, bring in comp committees, really create a governance around there. But also be able to, one of the things that we do really well at this phase is we also help build advisory boards. With one company, the one I'm having a bug here for, we came in and we said, hey, this is great. You're selling to insurance, you're selling to financial services, you're selling to payments. Let's build an advisory board of people in the industry that has a practice leader that you can have a sounding board to get you to understand and talk to your customers. Though you have revenue already, it's not just about this revenue, it's about the following year and the next year. And that's something that we do really well because we go into our network and of these LPs and say, hey, we have a company that does this, who has experience at MasterCard and Visa, who has experience at the big insurance companies, and tap into that network and bring them in to help. Because that creates that magic that I talked about early on, that experiential piece. Because now I'm getting people that, they're sharing in the risk, but they want to help this founder grow. And the founder also, can't pay for a lot of these people at this first, larger round. They've got to try to end it to get themselves to that $10-20 million funding round next.
That's a great point, and I love the idea of, you can bring in fractional help. Most companies at that stage don't need a full-time CFO. There's just not enough to go around to actually go out and hire someone who has experience as a full-time CFO, right? So the fractional work would be helpful. And then obviously coming out of that seed stage, right? Okay, let's start to professionalize this so that you go into some of these larger organizations, they're looking at something that they have trust that this product will be around. We're not going to buy this thing and then invest in you as a software provider. And the next thing you know, the company's going down.
And Darius, you brought in a right thing, because when you're, trying to sell to these insurance companies, these banks, they're not going to come in and everybody thinks they're going to, oh, I'm going to come into my pre-seed or seed startup. No, they're not. They want to wait until you're more established. And it's funny because I talk to a lot of founders and they have this perception, I'm going to close Bank of America. I'm going to close this bank. And I'm like, no, you're not. Like, they're not ready for you and you're not ready for them. And when you are, it's usually a procurement phase and they need to make sure you have quarterly financials. They want to know who your advisory board is. They want to know what your board looks like. They want to know what governance there are. And that's something that's critical, because that's where I think we're filling in this incredible is when these pre-seed and seed companies emerge, because there's usually in every space 5 different 10 competitors. They come out, they're now at $1 million or $2 million in revenue. Now we as a fund can walk in and say, great, now let's get you institutional ready. Now let's put more gas on the fire, but also bring you into our network of incredible partners that are looking for companies like you.
No, I think that's great for founders to hear, particularly the ones who are selling to enterprise. I remember looking at an investment. It was like this AML KYC platform using artificial intelligence, had brought on a bunch of small banks and then said, hey, look, we're going to churn these customers and then really focus our attention on the big banks. And I'm like, this is not At this point where the company was, I'm like, this is probably going to go not as well, just because like the sales cycles are longer, right? And so you're churning off revenue, and then you've got a 2 year sales cycle on the side of an enterprise, and then some of the other dynamics that you brought into play about the pieces that need to be put into place before they actually sign that agreement, right? It's like, theoretically, you want the bigger check from a more established, larger business, but operationally, there's just a lot more that needs to happen before you can be secure that's going to be the outcome. I did want to touch on, since artificial intelligence is the wave here these days. You mentioned 2016. Part of your kind of investment thesis was to invest in AI alongside cybersecurity in fintech. How do you think about investing in AI startups that either are AI native or that have some portion of their product development lifecycle implementing AI into its product suite?
16, as you mentioned, and some of the core gaps are still there. Some of the core piece of it, because I'll take a step back. When I had my first startup, it was an analytics company that was selling to the big brands.
Mhm.
And so one of the things that we did is we brought an analytics person. And this guy went deep into, he was building box plots, which are like little boxes with little lines that you see data scientists build. And we were learning about whiskers and outliers and this and that.
Mhm.
And so we got to learn a lot about what it takes to get to statistical significance and what does the data come from and cleaning the data. And this is a lot of work. But when you look at the AI market now, some of those issues are still there. Ownership of data, because AI is only as good as the base of data around. And that data, because really to get to statistical significance, you need 10,000 data points. If you don't have 10,000 data points, you get what's happening now when you look at generative AI, there's this 10 to 20% of hallucination, which is
Mhm.
it
Mhm.
makes shit up. For example, we have a mascot here who we call our senior associate, and his Twitter account is at real VC puppy. Well, we asked one of the LLMs, the large language learning models, who is VC puppy, and it came back as, oh, VC puppy is a real dog. And I was like, oh, this is now off the rails. And it didn't stop. It came back with a second piece that said, "Oh, beast." I don't know how it made up this answer. It then said is a term of professional endearment. So like that of like up and comer venture capital. And it literally created a quote. That guy is a real VC puppy. And I was like,
Mm.
wow, this is insane. I had another fund manager just last week enter it into ChatGPT. And he asked the question, who is VC Puppy? And he said, oh, VC Puppy is a pseudonym for an employee at Mendoza Ventures. And I was like, wow, this is like off the rails. And again, this is a
Yeah.
good example. We see examples where LLMs are making up citations, LLMs are making up quotes. That has hallucination. And the reason it creates that is because there's one data point. There's not the 10,000. If you go in, you do what's really right, and you say, hey, write a job description for a computer science manager, you're going to get something incredible because there's millions of data points out there. There's millions.
Mhm.
But when
Mhm.
you get to something where it lacks and data there, the hallucination,
Right.
either it just says, I have nothing, or it just makes up something that's fake. And you can do that when you're planning your wedding. You can do that when you're creating a job description. You can't do that when you're going through financial records, medical records, car incident reports, anything with human safety or your finances. Like that is a no-no. And so
Mhm.
what we're seeing right now is there's still a lot of emphasis on the data set. Who owns it? Where is it coming from? How do you supplement the data sets that you already have? There's a piece of right now, there's, I think, a fabrication of AI between the front end applications that are using LLMs that are
Mhm.
great because now you can, in our case of analytics, no one was looking at these reports. No one was like
Right.
generating insight, even though you're saying, hey, look, I found something for you. Nobody cared. Now someone can type in a question like, what is the top performing customer? Who is the top performing company?
Mm-hmm.
Yes, there may be hallucinations, but at least you're getting of a data set, you're getting someone to ask it questions that you're interested in versus the on the back office, that's where the data is. Who's transforming it? What rails is it on? Is it using one LLM? Is it using multiple? How are those LLMs training? And more importantly, at the enterprise level, ownership, data, that's something that we're investing a lot in now is
Yeah.
how do you transform the data, who owns it, but also how do you build generative AI for the enterprise?
Question for you. Do you draw a distinction in terms of value between a startup that is what I will call AI native and a startup that we would not consider AI native? However, their platform is built based on using API calls to like a Llama or to a OpenAI. One of the, basically just leveraging the infrastructure of these LLMs.
The problem there is it comes always down to defensibility. I'll use a good example. About 10 years ago, I met a founder. I didn't invest in this founder. He was working on something with like profiles and trying to match one profile to the other profile. And I was talking to him and I said, hey, this is really cool. But like, where are you getting this data from? And he's like, well, I'm using API calls to this other company and I'm using these API calls are coming from, and I'm scraping this data. And I was like, this is a huge risk because the day that they want to shut you down, they can't. And you don't have access to this data. And wouldn't you know, 6 months later, they shut them down. They're like, no,
Hmm.
we're shutting down your API calls. You can't knock on this door ever again. And that killed the company. And that's the thing with these sort of, and these companies, these AI companies that aren't native, and they're usually at the application layer. They're using like APIs into existing LLMs, into Llama, into like all of these. But the day that you're going to get shut down, you know, that there's no defensibility. You've got to sort of rewrite an application. And interesting enough, when you look at the second part that I worry about is also costs. Because right now, a
Hmm.
lot of
Right.
them are free. A lot of them are low cost. But the day that OpenAI and ChatGPT decide to charge $50 a call, that's going to decimate a lot of businesses. And one of the things we saw this with the fintech industry. You know, 5, 7 years ago, it was nearly impossible to build a fintech. Now there was, all of these Dawala, there was all of these services that you can build a harness, use APIs to pull, use APIs to like get banking as a service. And then what ended up happening is the cost started getting more and more exponential. And that ended up like the good startups were the ones that saw it coming and were like, I've got to build my own back office. I've got to go build my own
Hmm.
banking as because I've talked to a number of startups that were in this, same issue, APIs, and then the cost of what they were paying, getting paid, was they were in the negative with the cost to the financial services providers. And so that's where I think there's still going to be a disconnect because for a lot of the AI platforms, a lot of the LLMs, a lot of the ones that are free right now through Google, through Amazon, like there hasn't been a consumption model or a service model of how those are going to get paid. But there's using, right now what they're doing is they're just gathering data and they're gathering,
Hmm.
but the cost of compute is going to end up outweighing the cost of new data in. And so that compute's going to get paid by somebody and it's going to be that startup that's using it. And if you're not ready to take on those costs, it could shut you down.
Right. Yes, definitely something to think about for folks trying to deploy AI. It almost seems like, the entire world is trying to do it simply for the fact that it's kind of like everyone needs to do this, but also other things to think about related to actually building or deploying some type of AI solution. So I know we're coming up on time here. I wanted to leave a few minutes for folks who want to follow up, learn more about you. where can they find you? And also anything interesting that we should know about coming up in, I guess we're moving into 2025 here, but anything we should look out for Mendoza Ventures?
Yeah, I mean, we're continuing to go. I'm pretty excited. You can follow us on LinkedIn. We are really, really active on social media, which is unlike most VC funds. We're also active in traditional media as well, but usually we use a lot of LinkedIn to, founders reach out through there, funders reach out through there. You could follow VC Puppy on Instagram at VC Puppy. He is not a real dog; he's a plush dog, but he's our senior associate. And that's it's like, for the founders, get to know us. When you reach out, hey, I saw you on Darius's podcast. Here's why you would be a good fit. Don't just do a blanket, oh, investor, go. It's really built like the great founders that we connect with are the ones that have an idea of, you know, why we're a good fit. What does our portfolio look like? Maybe there's a complement. Maybe there's an area where it could be a fit within what we're investing in now. Same thing, like, do you fit into those guardrails of that 1 million in revenue within our verticals? And if you're a funder and you're interested in learning more about what it's like being an accredited investor, what it's like, we have a nonprofit called Mendoza Impact and MLPs. It's pretty incredible because we have people that will enter the form in our website. Hey, my wife and I, we want to invest in Mendoza Ventures. And that's something that doesn't happen in venture. But I really love that in this community, we've created this model where people outreach and want to learn. Some of the best investors I've had, ones that reached out to me and were like, hey, I saw what you wrote. I saw a podcast like this. I want to learn what it's like to invest. I want to learn what it's like to build my own track record. And same, for those that are fund managers that are learning, feel free to reach out. We're always trying to help. We're connected to, I'm a mentor at Black VC. I'm a mentor at Somos VC, the trade organization for both Black and Latino fund managers. So we're always, trying to help grow our community of more people that are getting checks out into the world.
All right, awesome. And they'll have plenty of detail to have a good lead into the conversation based on all of the great things that you've shared today. And we'll make sure we get the links included in our show notes. So do check there if you all want to connect with Mendoza Ventures or Adrian themselves. But Adrian, again, appreciate you taking this time. It's been super helpful and a very, very in-depth conversation with you.
Awesome.
All right.